Are we heading for another market crash? That's the question that most traders and investors like you and I are asking right now. And it's clear to see why. 1% down on the open means that we have data that we need to talk about today on what tends to happen next. On top of that, 82% of stocks finished in the red, and we saw a big move in the largest hedges in the world and yields across the board. So it's higher for longer according to the FOMC meeting minutes, and everything's changing, which is increasing volatility. And of course, the bonds market is starting to wake up in a pretty negative way. A huge move in junks has us needing to talk everything about stocks, commodities, and cryptos together. Join us. This will be a good one. Well, welcome back everyone to The Daily Show. My name is Tom, and today we're discussing macro lead indicators and the data that's going to help you hopefully educate yourself to become a better investor and trader. If that's something that you think you're interested in, remember to subscribe, smash that like button, and hit the alert bell. So let's go into what happened during the session before we get into the data and the charts. And it was Nvidia that was holding up the market, with one of the hottest stocks of this year coming into a put wall, which we discussed in the previous video. Another thing that we've been talking about recently has been reinflation trades, and they were doing incredibly well. So let's take a look at what actually happened for the session. It all gapped down. We saw a little bit of a rally in the morning after what was over 1% into the negative side, which does bring with it some problems, which we'll discuss. And then they held firm for the rest of the session. Things like China were not necessarily as affected as much, and emerging markets were down, but nowhere near as much as the Russell 2000, which broke through some of the key levels. We also saw sectors that we expected to hold up. Energy doing nicely, defensive such as XLP certainly coming through, and semiconductors weren't down too badly considering, but it was really anything to do with basically yields that going up, which was the biggest problem. The small caps and of course those hyper growth stocks that have been struggling now for pretty much well over a year. So from the 5-day average, all of the reinflation trades have been the best. Gold still holding a 5-day average best, and energy also up. But you'll notice that there's still quite a lot of the sections of the market that are now down almost 3% across the board. So what was happening during the session? Let's talk CPI to get started here. Firstly, 82% of stocks were down through the session. And if bears want to continue in this market, they really need to keep a couple of days that look like that to show that there's a big movement in breadth towards the downside. If that does happen, we could be in for that correction that everybody seems to want, which is between like 5 and 10%. Now, what about the core CPI? Well, everyone's going on about how bad it was, but just really how bad was it? Is CPI sticky? I would say yes, it is, but this is nothing new to the market. So remember, the narrative of why we might sell off is just an excuse to allow the price action and to leave some retail traders holding the bag. And we've already used dark pool activity to kind of show that this was potentially going to happen, along with CTAs, which we're bringing up later on, that we're already starting to dump into this event. Did they know something we didn't know? It's possible. So CPI actually came in at 0.359 or something like that. You might think it's 0.4%, but that's just because of the way they end up putting it out. It was actually about 0.36. And really the biggest issues here were, in my opinion, the shelter component, which continues to be one of the stickiest and hardest to get rid of components of inflation. 0.4% again, this is so many months now of the same thing. And when you think about inflation, the biggest issues are realistically shelter and, of course, wages, because it's very difficult to ever bring wages back down. Now, across the board, I would say it was kind of as expected. Yes, it was about 0.06 more than anyone else thought, but I think the big excuse here was how many cuts we're going to get this year. The FOMC meeting minutes kind of showed that there's more work to do, and we're now back to the same point that we were in October of last year, so the October of 23. Now, if you remember, that was actually the bottoming of the market before this massive rip rally. So why are we not selling off anymore? Well, a lot of it has to do with earnings revisions, which we'll go through into this earnings season. You'll be surprised also over the last 4 weeks how many revision upticks there have been in some of our favorite sectors that price action has been in. But let's talk SPY gapping down, because we actually have quite a lot of data to do with CPI releases and gaps down in the morning that end up sticking. And as I posted over on X, this is something that I find very, very interesting. Now, if you know anything about market stats, between 60 and 65% of the time over multiple months, you're generally looking at a bullish trend. So when you're getting underneath that kind of bullish trend, you need to be paying attention. In fact, only 1 day later, we only had 35% of the time was the market actually bullish. So what are we expecting? Well, we'd be looking for continuation of the bears to actually push through here to really bring in that negative stat. Now, we'll talk about whether that's possible from an options perspective in just a moment, but we are in a negative gamma environment, which means that hedging is generally to the downside. I also want to talk about when CPI is high, what tends to actually perform well, because we may be in what we call stagflation, which is higher for longer rates and that 1970s kind of thing. What tended to do quite well during other periods of time. And when you look at this chart, of course, you're going to say, well, commodities look pretty good. I totally agree with you. But you know one that no one really discusses right now? It's got to be emerging markets. And emerging markets do very well because of their rare earth minerals and metals. And I think this is a section of the market that might just start heating up along with some other areas of the metals market that are starting to run. I spoke about this a little bit in my Monday macro, which I do for our Market Masters Club each week. If you're interested, 7-day free trial down below. And I really think that things are starting to heat up in other areas of the market, which most retail traders just don't look at. Take a look at this. The change in earnings revisions breadth by sector is huge towards some of the hottest market sectors. And you'll notice energy about 8 weeks ago was getting huge upgrades, 4 weeks ago getting huge upgrades, and even as little as 2 weeks ago getting massive upgrades. I wonder why price has been running up across the board. Then you look at banks also getting a big tick up, transportation also getting a big tick up, and another one of our favorites, materials, getting a decent little spike about 4 weeks ago. So things are certainly improving. Meanwhile, not so many upgrades for the semis and other sectors, which have started to do a lot of this. So yeah, following the money, following the flow, you can actually see that this was part of the reason why it was occurring. Now, what about Morgan Stanley's research into which commodities they expect to be the best this year? Well, everyone's on the copper train. Of course, we've been talking about copper doing very well for a while, and it does look like it's doing extremely well. Gold's been doing amazingly. We'll talk more about that later. Silver also starting to skyrocket, though still behind gold in terms of overall performance. But this one here, we're going to bring up on the charts, nickel, because out of nowhere, nickel's been trading very strongly the last 3 days. Now, let's talk about why this could be. Well, of course, inflation generally actually not so good for gold. Higher rates have historically actually pushed gold down. But when you have central banks buying gold out of control, and of course you also have a whole bunch of geopolitical tensions, and on top of that, you've also got potentially stagflation, gold can perform quite well indeed. And we also see historically industrial metals prices perform following troughs in the global industrial cycle have been positive across the board. And you can see here 3 months after the PMI trough, 6 months and 12 months, we tend to see an outperformance in nickel. We tend to see an outperformance in copper and even aluminium, gold, and zinc. So yeah, again, these metals trades are still possibly just heating up across the board. In fact, Goldman Sachs has gone so far to now predict that copper will rise in real price highs by 2025, surpassing any record ever really hit in time. And this is a big call. So every single one of the banks is basically floating into these things. And when they start to get into it, it can last for a while. Now, if you've ever done your history on stagflation, which we don't know we're in, but of course it's possible, you would know that gold is technically the best performer and commodities are the second best, followed by value versus growth. So with CPI, it's going to be one of those ones to follow. My personal opinion is the Fed's going to change the goalpost. So rather than having that 2 to 2.5% mandate, they're just going to change it to 3%. This is just my opinion. We'll see whether they do it or not. What do you think in the comments down below? But yeah, I'm not too concerned about the inflation. I think we've managed to get it mostly under control, but I do think it's an excuse to potentially sell markets. And we've already been seeing a little bit of that underneath the hood. So let's start off here by having a look at the S&P 500. Then we'll go into some deeper dives into the data history. And of course, we'll go through all the charts later on. But the S&P 500 was an interesting one. A big gap down followed by a new low take, which went underneath 51.46 and then rallied back up to 51.61. Now, because the market was selling off pretty much mostly before the market opened, you'll notice that it kind of opened and closed at a very similar level. And what this suggests is there wasn't really that huge buy the dips type of success that we've seen in most of the days so far, where everyone was trying to buy up the markets. Instead, what it was kind of stagnant after what was a bit of a shock from the markets into the open itself. If we also take a quick measure of what we end up having here, which was the last close to the open, you'll notice it was over 1% movement, which gave us that data report. So I would say the 5-minute chart and the daily chart, the bears were clearly winning out overall on that particular market. Now, when we also have a look at the futures markets, you'll see that the market managed to close underneath that last week, which was at 51.63. We spoke about in the previous video that Wednesday support was sitting around 51.75. And if we broke that, the chance of going down to the 5100 level became pretty positive. In fact, 51.75 to 51.50 was very, very likely indeed. But for day traders, it's actually now about getting back up maybe to 51.75 and potentially then seeing a sell-off. And I've put a quick anchored VWAP here off the previous day high, which often can mark out an area where shorters would come back in. So are the sellers in control? At the moment, yes. And of course, the next big buy zone, other than where we're at right now, would be around 5100. A break below that, I think, puts bears in control. And we end up with the chance of a higher correction. 49.84, weekly 20 moving average, finally getting that massive, massive mean reversion, or possibly even the biggest correction that we probably expect could happen right now, which is between 4,700 and 4,800. Now, a lot of you will be looking for those levels, but let's actually break down the smaller timeframes to see whether it's possible with the options. Again, it's been holding through. You'll notice quite a lot of series of long leg dojis, showing us that the market was happy with where it's sat and it's ready to make the next move. This is kind of like equilibrium of the markets. If the markets do rally up to this level, I could see some resistance being formed here. And it's certainly a zone I would be watching over the next 24 hours to see what happens. For bulls, you're going to need a little bit more action now. You're going to need to see that 52.50 broken above to really get the bulls back in control to a positive gamma environment. So let's talk about this negative gamma one. Here are the expirations coming up. The 11th of April, you'll notice 5100 is the put wall. So really anything that where we see sell-offs, there's a little bit of hedging that would need to be done for the day. And of course, if we got underneath 5100, a lot of hedging would need to be done. So just watch here. But at the moment, the market is kind of more geared towards the 5100 than it is geared towards the buy the dip. And it's kind of an interesting one also for the 12th, because if the market did end up going down and holding lower, look how much hedging would have to come into this earnings report. We can see here puts starting to appear everywhere, which may possibly support the markets after maybe the next session. But if it does stay low, lots of hedging and therefore negative pressures. Remember, negative gamma environment, the first time we've seen it in ages in this market, almost any time in 2024 so far. And we first noticed this last week, along with this other thing, which is CTAs selling across the board. Here's the updates. The S&P 500 CTAs now down to those lows. And for the NASDAQ, you can see they've actually made new lower lows. So this is kind of signifying that we're in a similar period of time to where we were last year before that more major correction, where we actually saw CTAs dump in. Now, they do tend to go early. When we see CTAs dumping, it can mean something significant. So again, with price action, let's say it breaks through 5100, we turn even more negative gamma. You can kind of see why that could create a partial cascade effect, which could provide opportunity. Again, with the CPI numbers, are they bad? They're not good. They show higher for longer. But at the same time, I think that a healthy market pullback is something that we've all been looking for. And of course, it is also healthy for markets to do this. And we'll demonstrate why it's pretty common in just a moment. Let's also discuss this chart here, which I think is a really great one, which basically shows that risk was starting to become a little bit elevated in markets. We saw a very similar thing last year before we saw sell-offs from the CTAs. We're seeing it right now. Are we at an extreme opportunity in markets? No, because we're not above that 2 ratio. So we'll update you if that ever does happen. But at this point, the sentiment composite here made from these particular things is showing that, yeah, we're probably in a little bit of a not really great risk reward just yet for markets, and makes sense. Earnings reports are coming, and that means, of course, this Friday you need to be paying attention. JP Morgan, Wells Fargo, Citi, and BlackRock are all coming out. Here are the implied volatility moves. And when it comes to markets moving forward, continue to watch the commodities space, because as we said, the breakouts have been happening here. So for me, with this earnings, it's going to be commodities. It's going to be talking about, of course, whether these big tech stocks hold up, as they're pretty much the main expectation of the market right now. And if things don't hit, then we could be going into further pullbacks in the market. And is this expected? Well, during presidential years, this is usually a bit of a slow time for the markets, a sidewaysing action. And as we've talked about many times in the charts, you already know I'm going to bring up, we're kind of tracking 2012 and 76 right now, and we're kind of trading around here. So a pullback followed by bullish momentum is actually a full expectation of the markets. And I wouldn't necessarily be super scared if it does come down upwards of that 10%. I think it's pretty normal for that to occur in what tends to be around 2/3 of the way through this overall massive bull cycle that we're in. You can also see when you overlay it with other bull cycles, it is a period of time that often does see dips or slowdowns in the market, pullbacks in time, pullbacks in general, and then we tend to rally up for a little while. So things are still looking pretty good across the board. Now, on the surface of it, you would say, well, this doesn't look very good. Yes, Fitch Ratings just revised that China's debt outlook is negative and not stable anymore. Now, that's another downgrade across a major house. And as we know, we love a good downgrade when markets are starting to recover on the price action side. Multiple downgrades by Morgan Stanley last year. And when we look through history and we found the last 4 that happened, in every year, I think it was after the overall market was actually bullish. And bullish in a double figure way. So another house coming in to downgrade China. I don't think that's a negative thing. As you know, when they do those types of things, and especially everything else we've been seeing out of China, it looks dire. It probably is. But the market is also 70 to 80% down. So price action still is key. And that's why you follow the price and not the narratives. Let's take a look here at what's going on with the overall dark pool activity. Now, we first reported this on Monday that we saw some massive sells. Well, we assumed there were sells because it looked like distribution for the Ultra Pro. That's a 3x leveraged fund for the S&P. Then it's followed through, of course, to the negative side. And to me, it still looks like distribution at this stage. You'll see that actually it's been pretty good along with the RSP, which also had a massive trade on it. And as you might notice here, whenever we've seen these RSP trades in particular, especially the dark pool ones, they've either led into pullbacks in time, huge bottoming zones, or topping of markets, topping a market soon after with correction kind of capabilities. So it is suggesting that someone's leaving us to hold the bags for now. Of course, if he came back in 6 months' time, I'm sure it wouldn't be so bad, but that is in itself pretty surprising. Also, one of the largest trades we've ever seen, the largest trade we've ever tracked or seen on the S&P 500 Bear 3X fund SPXS just went through over the last 24 hours. But let's jump into the charts together and breeze through a few of these with some key levels. We'll start off with the VIX. So the VIX, we already know, above 16, huge deal, the worst thing we've seen in a while from the bull side. And of course, this is kind of bringing the bears into this market. So something that is certainly happening across the board. Then we go over here to the MOVE index, which is the bond market option volatility, and that spiked in a big way. Now, you don't always see necessarily this being a huge negative towards markets, but it is something where you've got to be paying attention. We already saw some options trackers that we've been watching last week spike up from the options market. And I think the big one here has to be that central banks are not supporting the market anymore. They're basically held firm. In fact, world central banks have been dropping. And we saw yields break out 4.948% with bonds falling through. Now, it makes sense to see bonds start to suffer. But if you have a look here, remember 76 to 77 is where we have a big put wall for high yield corporate bonds. And we traded at 76.5 by the close. Now, in all intensive purposes, this is actually a close below. And it kind of warns us that the bonds market is starting to get kind of sick. And that's telling us that maybe markets do have that corrective path in them. Again, price action will be key from the S&P 500, but the Russell is also showing a very similar thing. So definitely on many hands, we are now seeing the most negative thing we've ever seen in 2024 so far, and the bonds market is kind of confirming it. Now, I have tracked it with a couple of other bonds indicators, and to me, the one thing about the bonds indicators right now is that when you take yields out of them, they're not necessarily as bad as you would look at, but I can't ignore the price action here on HYG. And if it does end up closing the week down, I think it's a very significant coil into breakdown, which is, again, a warning sign for the markets, at least for potential correction. Another warning sign is now that the dollar has broken out and strongly closed above on the daily here, and weekly will hopefully close above, that's signaling that we've got a little bit more. Now, we've talked about 105, kind of 80 for the US dollar for a while, and it looks like it wants to go there. So for currency traders, it looks like volatility is back in and pullbacks to be met by bull demand when it comes to the US dollar as it moves towards our next levels of equilibrium. So it's kind of in no man's land right now on the left-hand side. This is a fairly major move, and it's moving all currencies across the board. Copper continued to hold high, although it has kind of hit its first take profit. So although the bullishness is there for copper, maybe it needs to take a little bit of a rest before it keeps going. it does have really strong kind of 6-month, 12-month correlations. It's the same with gold as well. Everyone's on this trade. We love gold. Don't get me wrong. I've still got a 3,000 target on it over the next year to 2 years, and I've discussed this for a long time. Volume's been spiking, but I took the distance from this bit to here, and you'll see it correlates perfectly. I've got a little red stop sign here, and that's just basically an indicator telling me that it's a little bit exhausted on the charts. When we have a look at silver, it's kind of the same level of exhaustion. I do think silver is a stronger trade. If you had to pick between either or, I'd say silver looks better. And that's just because silver gold ratio is at 0.012 versus 0.013, which is where it usually gets to. So it's kind of undervalued to current gold price. And you might say, well, that's because it's not as rare a metal or something. Yeah, it still trades at 0.013 quite a few times. Oil was a great surprise. If you were trading oil off that big demand level, you would have been very happy. And this was an absolute El Clasico. It took down here, got into the lows, got into the bottom of our box range, spiked back up. And it's kind of showing you that oil might have more to go, because the fact that it did this, we talked about this scenario, I think, in the previous video. When it does something like this, it kind of signals that it's got more bullish left in the tank. Now, nothing is for certain, but it does look pretty good for oil, whether it's Brent or US oil across the board. Another one we mentioned before was nickel. Take a look at nickel's drive up here over the last couple of sessions. Huge volumes. Obviously might look like a bit of a blow off with such a big wick, but I think somebody obviously has been buying, and their volume has remained incredibly strong now for quite some time. Kind of looks like an accumulation by quite a lot of larger traders out there. XLE looking really good. Just remember, if you're looking at XLE by itself, you're thinking, oh, that's a bit high. Well, when you look at XLE versus SPY, you're going to get a very different scenario. So always look at your versus other markets just to see whether it's doing well. Semiconductors remained fairly kind of flat. You can see here SMCI coming off its little support base, and NVIDIA managing to hold a bullish session. Now, it's not out of the woodworks yet. To make it out of the woodworks, you really need to see it close above 887, but NVIDIA holding up a little, and I think that's just because it's been sold off recently. It's kind of like a partially defensive place. Remember, larger funds, they always have to be invested in the market. So if they're freaking out about something else, they'll push across to what they deem is at something like technical support. Now, I do think NVIDIA, if the market does start to fall, could go lower. 786 and 680 are, of course, longer-term possibilities for DCAs for some people, and that's something that we've been looking at on the charts. AAPL also kind of weakening here. Obviously, the stock's got many problems. We are looking for it to break below to really, again, instigate further selling, but we don't know that's going to happen yet. So for now, the chart doesn't look good. I'm not a buyer in AAPL at this price. Tesla, man, held pretty good, 2.89% down. You might say that's pretty bad. I'd say it's been moving quite a lot, so it's not too bad. Volume has remained pretty good. No, of course, double bottom yet. 185 to break out for swing traders, and still just holding in the zone. So, yeah, overall, Tesla didn't do too badly. Let's now have a look at the Aussie 200. That's the one I want to watch. So, of course, Chinese stocks broke out yesterday to 17,000 on the HSI. But just a reminder that Aussie market and the FTSE, that's the UK 100, see how resilient they are? And that's because of the metals, the energy, and the financial markets. So if we put in the UK 100 as well, if you understand these particular indices, they're just not getting hit. Look at this. The UK market doesn't care. And we talked about this a few weeks ago with the breakout from here still being very bullish for it. And everyone's trying to short this market, and I just don't know why they're trying to short it. It is not a good idea to short into reinflation or hot CPI or stagflation or whatever you want to be talking about it. The UK and the Aussie markets are very strong from that perspective. Another one that's pretty strong at the moment has, of course, been the HSI. It did drop, which is the Chinese market, but it's still kind of trying to hold above that 17,000. You'll notice the previous close did hold. It bounced off the trend line, which is a fairly significant one that goes back all the way to this fall from 23, and it's still making a series of higher highs and higher lows. So still looking pretty good there, and there's plenty of AI stocks that are relatively cheap on the books as well. What about the US 2K? That's not a good close for it. Look, it's gone through our ascending channel. Of course, you could argue, well, look at this. It closed right on the low. There's no doubt it did close onto a major support, which we had there, 26. But still, it went through. It could do like this type of thing. I'm not super bullish on that chart until we get back above these levels. And unfortunately, I'm going to need to see more structure. One day of sell doesn't make me want to buy the dip on the Russell. Maybe it is the buy the dip scenario, but I don't know. It doesn't look too good to me. What do you think about the Russell? Let me know in the comments. NASDAQ pressured down into the 17.8, held it. So again, another market here that's holding these major levels. Now, it got down to 17.8, 7.6. Of course, for bears to really get control, you'll need to get underneath 17,800. But you'll notice there has been buying around here. So the bulls are still there. They're just not as flamboyant as they once were. They're not as interested in the market at these stages. And we do still have a series of lower highs, which until it's broken, the bears are in control of the smaller timeframes. To get really in control of the swing, though, they'd break this level. So NASDAQ still pseudo-neutral, I guess, is the way I'd look at it. Probably neutral would be the best way to play that trade. Let's have a look here at Bitcoin. It's another kind of neutral one. You'll notice I've got a stop sign here showing that it's maybe a little bit extended, needs to have a pullback in time, needs to have a bit of a rest. It does seem to be doing that. If you're going to go with direction, of course, you're going to go bullish just because the trend is still bullish and the overall action down here was still bullish. So for this stage, I'm still neutral on this stock, on this particular coin. If I was holding it long term, I'm very bullish on it. If I was looking at it in the next couple of weeks, I'm not sure. I mean, for me, it kind of looks just like bullish, but I'm not going to place a trade on it. If you are, though, maybe you need to go with the trend. Good luck on the Bitcoin. It is still a very interesting chart. Now, when we go over to the charts for the rest of the week or the news that's coming out, remember core PPI comes out on Thursday before the market, so that may also be a catalyst. And then we've got Friday kicking off the big earnings season with the banks. So it's exciting times ahead. Remember to subscribe if you enjoy today's content and you like what we do here. Subscribe, smash the bell. I'll see you in the next one. There's so much stuff going on. Also, follow us in the links down below and have a great day, guys. Bye for now.